If you're putting aside spare cash either every month as you earn it or as a one-off sum, for example after a bonus, one of the big questions is, should I save or invest? And here's the thing, people tend to pick a side. Some say, I'm a saver, I'd never risk the stock market. Others say, I'm an investor, I want my money to actually grow. But what if I told you this isn't really an either-or question at all? The reason is that your money has different jobs to do. Some of it is for everyday life. Some needs to protect you or support short-term plans, and some of it should work towards your future. So the right choice usually comes down to the job you're expecting your money to do. Hi, I'm Gary, and today I'm here with Money Farm to clear up the confusion around saving versus investing, because understanding the difference and knowing when to use each one could be one of the most valuable financial lessons you'll ever learn. Before we get into the details, here's why this topic matters more than ever. The UK has always been a nation of cash savers. We like the security of knowing our money is safe in a bank account. But here's the problem. When we default to cash for everything, we can miss out on opportunities to build real long-term wealth. The government knows this. In fact, during the 2025 autumn budget, the Chancellor announced changes designed to nudge people toward investing. From April 2027, if you're under 65, you'll only be able to put £12,000 into cash ISAs each year instead of the current £20,000, which means if you want to use your full £20,000 ISA allowance, you'll need to invest at least £8,000 into a stocks and shares ISA. And as we explained in this video that you can find on the channel, this isn't about taking away choice. It's about encouraging people to think differently about their money and consider investing for their future. So let's break down what saving and investing actually are, when each one makes sense, and how they can work together. Let's start with saving, because it's what most of us are already familiar with. When you save, you're putting cash into an account like a savings account with a bank or a cash ISA. Your money sits there safely, and ideally you earn some interest on it, helping it grow a little over time. The amount of interest you earn depends on things like current interest rates, how long you're willing to lock your money away, and whether you're saving regularly. Generally, you'll get higher rates if you commit to leaving your money untouched for longer. The big advantage of cash savings is certainty and security, as your balance won't suddenly drop in value as investments can. But does saving like this always make sense? Well, actually, it makes sense specifically in two scenarios. The first is when you are building up your emergency fund. This is your financial safety net that you can access quickly if your car breaks down, your boiler packs in, you lose your job, or something else unexpected and expensive happens. The typical rule of thumb is to have between 3 to 6 months of your essential living costs saved up. So if your rent, bills, groceries, and other must-pay expenses come to £2,000 a month, you'd want somewhere between £6,000 and £12,000 set aside. Of course, bear in mind that this is just a high-level rule, and the actual amount will depend on personal circumstances, responsibilities, and liabilities. But it's still a useful rule of thumb when thinking about an emergency fund. The second scenario where saving makes sense is for shorter-term goals, things you want to achieve within the next 3 years, like next year's holiday, a new kitchen, a wedding, or even a house deposit. For these kinds of goals, cash savings provide better capital security, ensuring your funds are protected from market volatility over the next few years, without the risk that it could be worth less if markets have had a bad spell. But if your situation doesn't fall within these two scenarios, you should probably start looking into investing. The reason for this is that if you're saving for something more than 3 to 5 years away, like retirement, your children's future, or building long-term wealth, cash has one major drawback: inflation. Inflation is the gradual rise in the cost of goods and services over time. Think about what a chocolate bar or a pint of milk cost when you were younger compared to now. Well, That's inflation at work. When prices rise because of inflation, your money doesn't stretch as far as it used to. So even if your savings balance is growing because you're adding to it and earning a little bit of interest, the purchasing power of that money is actually being eroded. Let me put it this way. If you have £10,000 in a savings account today and inflation is running at 3% a year, in 10 years, you'll still see £10,000 in your account plus whatever interest you've earned. But that money won't buy you as much as it does today. That's why saving cash for long-term goals can feel like trying to climb up a down escalator. You're putting more in, your balance is growing, but what you can actually do with that money struggles to keep pace with rising prices. This is where investing comes in. Investing is designed to help you reach longer-term financial goals and build wealth for the future. When you invest, you're putting your money to work, so you buy investments like shares in companies, bonds, or funds with the aim that they'll grow in value over time. So when you eventually sell them, you have more money than you started with. But why does investing have the potential to grow your money more than cash? Well, when you invest in shares, either by buying them individually or through funds like ETFs or mutual funds, you're essentially buying into businesses. These businesses are aiming to grow, generate profits, and increase in value. And when they do well, and when the economy as a whole performs well, the value of your investments can rise. Some businesses also share their profits with investors by paying dividends, which gives you another source of potential growth. Over time, this growth potential is usually better at keeping up with or even beating inflation than cash is. And historically, that's exactly what's happened. Over the long term, returns from shares have beaten cash held in savings accounts, although, of course, there's no guarantee this will continue in the future. So investing makes sense when you're thinking about the long term, but there's one thing you need to consider first: risk. Unlike cash savings, where your balance stays the same or grows steadily, investments can go down as well as up, as the businesses you invest in won't always perform well, and neither will the economy. So the value of your investments can fall, and if you need to sell when values are low, you could get back less than you put in. This is what puts a lot of people off investing, and it's understandable. No one likes the idea of losing money, but here's the thing: risk is part of investing, and you can't avoid it completely. So when you're aiming for long-term growth, accepting that values will go up and down along the way is part of the trade-off. That said, you can also manage risk, and for most people, it's not even that complicated. Basically, you need to remember three things. First, what you invest in matters, as some investments are riskier than others. For example, shares in emerging markets are generally considered higher risk than those in more established markets like the UK or the US. And larger, well-established companies, like many in the FTSE 100, tend to be less volatile than smaller, newer businesses. Second, diversification makes a huge difference. Instead of putting all your money into one company or even a handful, you spread it across plenty. That way, if some of your investments are struggling, others will hopefully be doing better. This is exactly what funds and ETFs help you do. They let you invest in hundreds of companies in one go. Third, and this is crucial, time matters. Because investment values can go down as well as up, the golden rule is that you should only invest money that you can comfortably leave untouched for at least 5 years. Why 5 years? Because it gives you time to ride out the ups and downs of the market, and you won't be forced to sell when the values are low just because you suddenly need the cash. History gives us plenty of examples of this. Think about Black Monday in the 1980s, the dot-com crash in the early 2000s, the financial crisis in 2008, or even the market drop at the start of COVID in 2020. In all these cases, markets recovered over time, but only investors who had the time to wait benefited from that recovery. Considering all we talked about, you should see why all this isn't really a question of should I save or should I invest. invest. It's a question of when should I save and when should I invest. Therefore, you should think about your money as a toolbox, and saving and investing are two different tools, each perfect for different jobs. Some of it needs to be readily available for emergencies or short-term needs, and that's where cash savings come in. Some of it should be working toward your long-term future with the potential to grow and beat inflation, and that's where investing comes in. Think of it like this. Cash savings are your financial foundation and your safety net. They give you security and peace of mind. Investing is how you build on that foundation for the future. Most people need both. You need cash for your emergency fund and short-term goals, and you need investments for your long-term goals and wealth building. The key is understanding which part of your money is doing which job and making sure you're not leaving all your money in cash when some of it could be working harder for you through investing. So, to recap, save for your emergency fund and for goals within the next 5 years, as cash gives you certainty and security. Invest for goals that are 5 years or more away, as investing gives you the growth potential that can beat inflation and build long-term wealth. And remember, you don't have to choose between saving and investing. You can do both for different purposes. And if you're ready to start building your financial future, whether that's through saving, investing, or both, Money Farm can be the platform for you. So have a look at the description below for more info. And as always, see you in the next video. Bye.